Price tags on everything from laundry detergent to canned soup are ticking upward at a rate that hasn't been seen in decades. Standard economic reports point to crude oil spikes or new international tariffs to explain the 2026 inflation wave. Underneath those visible figures sits a 3-century-old financial lever: maritime war risk insurance. This cost is essentially a ghost in the machine of global commerce. It is buried deep within freight quotes and absorbed into supplier invoices long before a product ever reaches a retail shelf. Geopolitical conflict in the Middle East is functioning as an unlisted tax, quietly levied on every grocery bill in the country. Before February 2026, a standard trip through the Strait of Hormuz carried a war risk premium of roughly $250,000. In less than 3 weeks, that same voyage cost jumped to over $7.5 million. This $7 million surcharge flows directly into the petrochemical pipeline. The crude oil transiting the strait is the primary feedstock for synthetic fibers in clothing, plastics used in cosmetic packaging, and the foam in home furniture. As insurance costs spike, they ripple forward. Higher premiums inflate freight rates, which drive up manufacturing inputs, eventually forcing retailers to raise their final prices just to maintain their margins. A geographically distant shipping choke point has become an immediate, unavoidable household financial drain. To understand why this happens, we have to look at how marine risk is calculated. The system dates back to 1688, starting as informal agreements passed around tables at Edward Lloyd's Coffee House in London. Today, a commercial vessel carries a complex insurance stack: hull and machinery, cargo, protection and indemnity, and a fourth separate layer called war risk. This layer covers terrorism and hostile acts. It's explicitly excluded from standard policies and must be procured separately. Without that specific add-on, a ship cannot legally dock at major ports, and banks will refuse to finance the voyage. It acts as the functional license for global trade. On February 28, 2026, following coordinated U.S. and Israeli airstrikes on Iran, the Islamic Revolutionary Guard Corps issued a severe threat to strike any commercial vessel attempting to pass the Strait of Hormuz. Within 72 hours, at least 7 major insurance clubs issued mass cancellation notices. They pulled their war risk coverage entirely across the Gulf region. This graph reveals the speed of the market reaction. During the 8-year tanker war of the 1980s, rates climbed gradually to around 5%. In 2026, premiums hit 7.5% and in some cases 10% in less than 3 weeks. In past conflicts, shipping continued for a high enough price, but the threat in 2026 was so acute that the strait became mathematically uninsurable for the private sector. When standard actuarial risk models fail, private markets retreat, leaving the global supply chain in a state of paralysis. The disruption reached such a critical level that on March 6th, President Donald Trump issued an executive directive for the U.S. government to step in as a federal sovereign backstop for global shipping. He assigned a $20 billion maritime reinsurance task to the Development Finance Corporation, an agency with no prior experience in marine claims or oceanic risk management. This intervention is designed to artificially cap the market ceiling. By having the government absorb catastrophic loss, private insurers can begin underwriting policies again and restart the flow of oil. The private insurance market, the 300-year-old foundation of merchant shipping, is now unable to operate without a multi-billion-dollar direct guarantee from the United States Treasury. Let's run the exact math on a very large crude carrier. It holds approximately 2 million barrels. If war risk premiums add $7.5 million to a single voyage, that represents exactly $3.75 tacked onto every single barrel before the cost of actual oil is calculated. That same mathematical burden applies to other vessel classes. Major carriers like Maersk added surcharges of up to $3,800 per container, directly inflating the transport cost of imported electronics, furniture, and food. Because shipping costs are embedded in the production of almost everything, this dynamic creates a simultaneous spike in inflation and a stall in growth, the definition of stagflation. The 2026 Hormuz crisis is operating while Red Sea traffic is already down 60%. 2 of the world's most vital maritime choke points are compromised at the exact same time. Insurers and businesses are no longer treating this as a temporary shock. They are pricing in a new reality, where elevated geopolitical risk is a permanent operating cost. Companies must audit their supply chains down to the sub-supplier level and build intentional inventory buffers. Just-in-time manufacturing only works when logistics are predictable. The era of cheap global shipping is over, and the cost of that transition is currently sitting on your grocery receipt.